What if I told you that almost everything you believe about investing is wrong? What if the strategies that feel the most logical, buying stocks when they're hot, following the news, chasing returns, are actually the very things that are quietly destroying your wealth? And what if there was a book written over 70 years ago that already figured all of this out, and most people still haven't read it? Today, we're going to change that. We're going to break down one of the most important investment books ever written, a book that Warren Buffett himself called by far the best book on investing ever written. A book that shaped the fortunes of some of the world's wealthiest investors. A book called The Intelligent Investor by Benjamin Graham. But here's a warning before we begin. This isn't a book about getting rich quick. It's not about picking the hottest stocks or timing the market. In fact, it's almost the opposite of what most financial influencers and TV commentators talk about. This book is about thinking differently, about protecting yourself, about winning not by being the smartest person in the room, but by being the most disciplined. So let's start at the beginning. Who was Benjamin Graham, and why should you care? Benjamin Graham was born in London in 1894 and grew up in New York City. His family lost almost everything when his father died young, and Graham watched his mother struggle financially during one of the worst stock market crashes of the early 1900s. This experience left a deep mark on him. He understood, from real life, not just theory, what it felt like to lose everything because of poor financial decisions. He went on to study at Columbia University, graduated near the top of his class, and eventually became one of the most respected investors and financial thinkers of the 20th century. He taught at Columbia for decades. His most famous student? A young man named Warren Buffett, who said that Graham's ideas changed his life and made him billions. Graham first published The Intelligent Investor in 1949. It has been updated and revised several times since. But the core ideas, the heart of what Graham was trying to say, have never changed. And they're just as relevant today as they were back then. Now, before we get into the specific concepts, I want you to understand one foundational idea that runs through every single page of this book. And that idea is this. The stock market is not a machine that rewards the smartest people. It's a place that constantly tests your emotions, your patience, and your discipline. And the investors who win over time are not the ones who are the most brilliant. They are the ones who make the fewest emotional mistakes. Let that sink in for a moment, because it runs completely against what most people believe. Most people think investing is about intelligence, about finding that one secret stock, about being faster and smarter than everyone else. But Graham says no. He says the real enemy of the investor is not the market. It's the investor themselves. It's the fear, the greed, the impatience. Those are what destroy wealth. And to explain this beautifully, Graham gives us one of the most famous and powerful concepts in all of investing. He calls it Mr. Market. Imagine you own a small business, and you have a business partner. His name is Mr. Market. Every single day, without fail, Mr. Market shows up at your door, and he gives you a price. Sometimes he wants to buy your share of the business from you. Sometimes he offers to sell you his share. And here's the thing about Mr. Market. He is deeply, profoundly, almost clinically emotional. Some days, Mr. Market is incredibly optimistic. He wakes up feeling great. The sun is shining, the economy feels strong, and he's so excited about the future that he offers you a very high price for your share of the business. He's practically begging you to sell to him. Other days, and this is where it gets interesting, Mr. Market wakes up in a panic. He's read the news. He's terrified. The world is ending, or so he thinks. And on those days, he offers to sell you his share of the business at a ridiculously low price. He just wants out. Now here's the question: how should you respond to Mr. Market? Most investors, most people, make the mistake of following his mood. When Mr. Market is excited and prices are high, they get excited too. They buy. When Mr. Market is scared and prices crash, they panic too. They sell. But Graham says this is completely backwards. He says you should treat Mr. Market like what he is, a slightly unstable neighbor who makes irrational offers every day. You are not obligated to respond to every offer he makes. You can ignore him completely. And you should only take action when the price he's offering makes logical, rational sense to you. Think about it this way. Imagine you own a small apartment building, and every single day, your neighbor comes by and makes you an offer to buy it. On Monday, he offers you $1 million. On Friday, he comes back in a panic and offers you $500,000. Did the building change? Did it become worse? Did the tenants leave? Nothing changed. Only his mood changed. A rational person would not sell on Friday just because their neighbor is scared. They'd say, the building is exactly the same. Your mood has nothing to do with its real value. And if anything, a very smart person might even buy more property from a scared neighbor at that low price. That is exactly how Graham wants you to think about the stock market. Stocks are pieces of real businesses. Their value doesn't change just because the market is having a bad day. And when the market panics and prices drop, that's not a disaster. For a truly intelligent investor, that's an opportunity. But here's the surprising part most people miss. Graham doesn't say this is easy. He says it's actually one of the hardest things a human being can do. Because when the market is crashing, everything inside you screams to sell. The news is terrible. Your friends are panicking. Your account balance is falling. Every instinct says run. And yet, the intelligent investor stands still. Or better yet, they step forward and buy. This brings us to the second major concept in the book. And this one might be the most important idea in all of investing. Graham calls it the margin of safety. Let's say you want to build a bridge. Engineers calculate that the maximum load this bridge will ever carry is 10,000 tons. So they design it to hold 30,000 tons. But because you never know, there might be an unexpected storm. There might be more cars than you planned. There might be an earthquake. So you build in a safety margin. You design for much more strength than you think you'll ever need. Graham says you should think about investing exactly the same way. When you buy a stock, you should only buy it when the price is significantly below what the business is actually worth. Not slightly below. Significantly below. So that even if you're wrong, even if the business performs worse than you expected, you still don't lose money. Or at least you don't lose much. This is the margin of safety. It's your financial cushion. It's your protection against your own mistakes, against bad luck, against things you couldn't predict. Here's an example. Let's say you believe a company is worth $100 per share based on its earnings, its growth, its assets. If the stock is trading at $95, Graham would say don't buy it. The margin of safety is too thin. But if the price drops to $60 or $65, now you have a real margin of safety. Even if you're slightly wrong about the company's value, even if it's only worth $80 instead of $100, you still made a profit. This concept sounds simple, and in theory it is. But in practice, it requires enormous discipline. Because when a stock is cheap, there's usually a reason. The news is bad. The company is struggling. People are scared of it. And buying something that everyone else is selling, that takes courage. It takes conviction. It takes the ability to separate the actual value of a business from the temporary emotion of the market. Now, here's where it gets interesting. Graham understands that not all investors are the same. Not everyone has the same amount of time, skill, or interest in deeply analyzing businesses. So he divides investors into two types. And he's very specific about what each type should do. The first type he calls the defensive investor. And the second type he calls the enterprising investor. Pay close attention here, because figuring out which one you are could be one of the most important financial decisions of your life. The defensive investor is someone who wants good results without spending a lot of time on it. Maybe they have a job, a family, other priorities. They don't want to spend their weekends reading financial reports. They want a simple, reliable strategy that protects their money and grows it steadily over time. For the defensive investor, Graham has a very specific prescription. He says, divide your portfolio between stocks and bonds. Somewhere between 25% and 75% in each, depending on the market conditions. When stocks are very cheap, lean toward stocks. When stocks are expensive, lean toward bonds. But never go below 25% in either one. Because this balance keeps you protected. If stocks crash, your bonds hold steady. If bonds struggle, your stocks can grow. It's simple. It's boring. And according to Graham, boring is exactly what most investors need. For stock selection, the defensive investor should stick to large, well-established companies with long track records of earnings and dividend payments. Companies that have survived recessions. Companies that aren't drowning in debt. Companies that have been around long enough that you can trust they'll probably still be around in 10 years. And here's something that might surprise you. Graham says the defensive investor should not try to beat the market. He says the goal is to match the market, protect against disaster, and sleep well at night. If you try to be clever, if you try to pick winners, you're more likely to hurt yourself than help yourself. Now here's the key thing about the defensive investor. Graham says this approach is not inferior. It's not the strategy for people who are too lazy to do better. He says for most people, for the vast majority of ordinary investors, this is actually the smartest thing they can do. Because the moment you try to be clever, you introduce emotion. And emotion is the enemy. Now let's talk about the enterprising investor. This is someone who is genuinely willing to put in the time and effort to study companies deeply. Not casually, seriously. They're willing to read annual reports, understand balance sheets, track industries, and do the hard work of finding genuinely undervalued businesses. For the enterprising investor, Graham opens up more possibilities. They can look at smaller companies. They can look at distressed situations. They can look at companies that are temporarily out of favor but fundamentally sound. But, and this is crucial, they must apply the same rigorous discipline. They cannot guess. They cannot speculate. They must always have a logical, evidence-based reason for every purchase. Graham is very clear that being an enterprising investor is not about being bold or aggressive. It's about being more thorough. The enterprising investor works harder, but not riskier. The extra work is supposed to reduce risk, not increase it. And here's something that might be the most counterintuitive thing in the entire book. Graham says that many people who think they are enterprising investors are actually something much more dangerous. They're speculators. And he makes a very sharp distinction between investing and speculation. An investor, by Graham's definition, is someone who thoroughly analyzes a company, confirms its safety and value, and then buys it with a long-term commitment. A speculator is someone who buys based on price movements, trends, tips, or feelings about where the price might go next. Both activities happen in the stock market, but they are fundamentally different. And the dangerous part is that speculation often disguises itself as investing. People who buy a stock because it looks like it's going up think they're investing. They're not. They're gambling. They just don't know it. Graham gives a very stark warning here. He says there is nothing wrong with speculation, as long as you know that's what you're doing and you limit the amount of money you risk. Keep your speculative money in a separate account. Set a strict limit, maybe 10% of your total portfolio, and never ever let speculation bleed into the money you're depending on for your future. But most people don't do this. Most people start out investing and slowly, without realizing it, slide into speculation. They chase a hot stock. They get excited by a trend. They hear a tip from a friend. And before they know it, their entire retirement savings is riding on a bet. Now let's talk about something that almost every investor gets wrong. And I mean almost every single person who participates in the stock market. This is about how to think about market fluctuations. When the stock market goes down, how do you feel? Be honest. Most people feel something ranging from mild anxiety to outright panic. And when it goes up, most people feel excitement, confidence, maybe even the urge to buy more. This feels completely natural, but Graham says this response is completely backwards. He says the market going down should not make you feel worse. It should actually make you feel better if you're planning to buy more in the future. And the market going up should give you pause, not excitement, because you're now paying more for the same businesses. Think about it like this. You love buying a particular brand of coffee. It costs $5 a cup. You buy it every week. Now one day, the coffee shop has a massive sale, 50% off. $2.50 for the same cup. How do you feel? Excited, right? You stock up. Now imagine the opposite. The price doubles to $10. Do you rush to buy more? You probably buy less, or you start looking for alternatives. Why do people behave the exact opposite way with stocks? When prices drop, a sale, they panic and sell. When prices rise, they're more expensive, they rush to buy. It makes no sense when you think about it, but it's driven entirely by emotion and by the herd mentality. When everyone around you is selling, the brain interprets that as a signal of danger. Graham says the intelligent investor must train themselves to think differently. Not easily. He acknowledges that this goes against deep human instincts. But it is absolutely essential if you want to succeed over the long term. And here's the data that backs this up. Studies of actual investor behavior show that the average investor earns significantly less than the average market return. Not because the market doesn't work, but because investors buy high and sell low, over and over again, driven by emotion. They consistently do exactly the wrong thing at exactly the wrong time. Graham wrote about this decades before the research confirmed it. He saw it happening all around him during the crashes of 1929 and 1937 and the various downturns throughout his career. Human nature doesn't change. And the market, which is driven by human nature, keeps making the same patterns over and over again. Now here's something very important that Graham says about market predictions. And this will either frustrate you or free you, depending on how you look at it. He says, nobody knows where the market is going in the short term. Not the analysts, not the fund managers, not the economists, not the celebrities. Nobody. The evidence for this is overwhelming. Study after study shows that professional forecasters are not reliably better than chance when it comes to short-term market predictions. This is actually liberating news, because it means you don't have to watch the news every day. You don't have to try to predict what the Fed will do next month or whether the economy will grow or shrink next quarter. None of that matters for the long-term investor. It's noise, all of it. What matters is the underlying value of the businesses you own. What matters is whether those businesses are growing their earnings, maintaining their competitive position, and generating real cash flow over time. That's what determines wealth over a decade, not what the market does next Tuesday. Let's now go deeper into how Graham thinks about analyzing a stock. Because while he's very clear that most people should keep it simple, he does lay out a framework for those who want to go further. The first thing Graham looks at is the company's earnings. Specifically, he wants to see a consistent track record. Not one great year. Not just this year's number. He wants to see earnings that have grown, or at least been stable, over the past 10 years. But because a company that has performed well over a long period in various economic conditions has proven something about its resilience. Next, he looks at debt. He is deeply suspicious of companies that carry too much debt. But because debt is a multiplier, it amplifies both good times and bad times. A company with lots of debt can make spectacular profits when things go well, but it can also go bankrupt when things go wrong. And for the conservative investor, bankruptcy is the nightmare you're trying to avoid. He also looks at dividends. He likes companies that have paid dividends consistently over many years. But because dividends are real cash, they're not accounting tricks. A company that has paid a dividend every year for 20 years has proven that it generates real earnings, real cash flow, and real returns for shareholders. And then there's the price. Because even a great company is a bad investment if you pay too much for it. Graham is very clear about this. He doesn't just want good companies. He wants good companies at good prices. There's a big difference. He uses something called the price-to-earnings ratio, or PE ratio, as one of his key tools. This is simply the stock price divided by the annual earnings per share. If a stock earns $2 per share and it's trading at $20, the PE is 10. Graham believed that for most defensive investors, buying stocks at PE ratios above 15 starts to get risky, and above 20 is usually territory where you're paying for optimism, not value. Now, some of the greatest companies in history have had PE ratios of 30, 40, or even higher. And sometimes those turned out to be great investments. But Graham's point is about risk management. At a high PE, you're betting that the future will be significantly better than the present. And sometimes it is. But when it isn't, when reality disappoints, the fall is much harder. He also looks at book value, essentially what a company would be worth if you sold all its assets and paid off all its debts. He likes to buy companies where the stock price is close to or below the book value. This gives you a floor, a sense of what the business is worth in the worst case. Now here's something interesting about book value today versus in Graham's time. In the early to mid-1900s, most companies' value was tied to physical assets, factories, equipment, inventory. Today, many of the most valuable companies are built on intangible assets, brands, software, intellectual property. These don't show up on the balance sheet the same way. So Graham's book value approach needs some adaptation for the modern world. But the principle remains the same: don't overpay. Always know what you're buying and what it's actually worth. Always demand a margin of safety. Now let's talk about one of the topics that Graham spends a lot of time on, and that most investors completely ignore: the issue of inflation. Graham warns very clearly that inflation is one of the biggest threats to the long-term investor. Here's why. If inflation runs at 3% per year, and your money is sitting in a savings account earning 1%, you are actually losing purchasing power every single year. Your bank balance goes up in number, but what you can actually buy with it goes down. This is why Graham argues that stocks, despite their volatility, despite their scary short-term swings, are actually one of the best long-term protections against inflation. Because when prices rise, companies generally earn more revenue. Their profits grow, and the stock price tends to follow over time. Bonds, on the other hand, especially long-term bonds, can be severely damaged by inflation. If you lock in a bond that pays 3% per year for 20 years, and inflation goes to 5%, you are losing real purchasing power every single year for 2 decades. Graham understood this deeply. This is why he recommends that even the most conservative investor keep a significant portion in stocks. Not because stocks are risk-free, they're not, but because over long periods of time, the inflation-adjusted returns of stocks have been substantially higher than bonds or cash. Now let's talk about something that really gets Graham fired up, the financial industry itself. Graham is not kind to Wall Street. He is not kind to stockbrokers, financial advisors who get paid commissions, or fund managers who charge high fees while underperforming simple index funds. He makes a very sharp observation. The people who sell financial products have interests that are often directly opposed to the interests of their clients. When a broker tells you to buy a particular stock, ask yourself, is this person being paid a commission on this transaction? When a fund manager charges you 2% per year in fees, ask yourself, is this person consistently generating returns that more than compensate for those fees? Almost certainly not. Graham points out a statistical truth that many investors still haven't absorbed. Most actively managed mutual funds, over any 10 to 20-year period, fail to beat a simple low-cost index fund. And yet they charge much higher fees. The math simply doesn't work out in the investor's favor. This was a radical idea when Graham was writing. Today, it's been confirmed again and again by decades of research. And yet the financial industry continues to sell expensive products, and investors continue to buy them because of the illusion that more complexity, more sophistication must equal better results. Graham says no. Simplicity, discipline, and low costs win over time. Now here's an important distinction that Graham draws, and it's one that a lot of people find surprising. He says the intelligent investor does not necessarily try to maximize returns. Let me repeat that because it goes against everything we're taught. The intelligent investor does not try to maximize returns. Instead, the intelligent investor tries to maximize risk-adjusted returns. Meaning, they want the best possible return for the least possible risk. This sounds subtle, but it's profound. Because most investors, especially beginners, think about investing as purely about how much they can gain. They chase the biggest returns. They take on more and more risk. They concentrate their portfolio in 1 or 2 sure-thing ideas. But Graham says the real game is about not losing. If you can avoid big losses, if you can stay in the game through crashes and downturns without panicking and selling at the bottom, then you will outperform most other investors over time. Not because you picked the best stocks, but because you avoided the worst mistakes. He uses a simple math example. If you have a portfolio worth $100,000 and it drops 50%, you now have $50,000. To get back to where you started, you need a 100% gain, not 50% to 100%. This asymmetry is why protecting against losses is so much more important than chasing gains. Think about that for a moment. A 50% drop requires a 100% gain to recover. A 25% drop requires a 33% gain. The math of losses is brutal. This is why Graham's obsession with margin of safety, with not overpaying, with protecting the downside, is not just conservative thinking. It's mathematically superior strategy. Now let's talk about something that might be the most psychologically difficult part of Graham's teaching. And that is the concept of being contrarian, of thinking differently from the crowd. Human beings are social animals. We are wired to follow the group. When the group runs, we run. When the group panics, we panic. When the group is euphoric, we want to join the party. This is not a character flaw, it's biology. It kept our ancestors alive. But in investing, this instinct is lethal, because the crowd, by definition, is always wrong at the extremes. When everyone is excited about stocks and prices are sky high, that's when the intelligent investor should be cautious. When everyone is terrified and prices are in free fall, that's when the intelligent investor should be looking for opportunities. Graham describes this with a quote that has become legendary in investing circles. He says, "Be fearful when others are greedy, and greedy when others are fearful." Wait, actually, that was Warren Buffett paraphrasing Graham. But the idea is pure Graham. The history of markets is full of moments where the crowd was wildly, catastrophically wrong. The dot-com bubble of the late 1990s. The housing bubble of the mid-2000s. Every time, people believed this time is different. Every time, they believed the old rules of valuation no longer applied. Every time they were wrong. Graham saw multiple cycles like this in his lifetime, and he emerged from each one not just with his wealth intact, but with greater conviction in his principles. Because each crash confirmed what he had always believed: value matters, price matters, and the market eventually, always, returns to reality. Now let's talk about something practical: portfolio management, and how Graham thinks about diversification. Diversification, spreading your money across many investments, is something most investors have heard of. But Graham gives it very specific meaning. He says the defensive investor should hold somewhere between 10 and 30 different stocks. Not just any stocks. Good quality stocks. Large, financially sound companies with consistent earnings and dividends. Why not just one or two great companies? Because no matter how confident you are, you can be wrong. A company you believe is rock solid can run into unexpected problems. A CEO can turn out to be corrupt. An industry can be disrupted by technology. Diversification is insurance against being wrong. But Graham also warns against over-diversification. If you hold 200 stocks, you essentially own the entire market, and you might as well just buy an index fund. The point of selecting individual stocks is to own the best ones. If you dilute yourself too much, you lose that advantage entirely. He also has very strong opinions about what not to do. Don't buy new issues, meaning be very cautious about initial public offerings, or IPOs. Graham says that IPOs are almost always priced to benefit the seller, not the buyer. The company is selling when it thinks the timing is ideal, which usually means the price is high. He's deeply skeptical of the IPO market. He also warns against following the advice of stock market letters and financial newsletters. He says that services that claim to predict where the market is going, or to identify the next hot stock, have no reliable track record and no real basis for their predictions. They sell subscriptions based on hope, not evidence. And he warns against trading too much. Every time you buy or sell a stock, there's a cost. Brokerage fees, taxes on gains, the bid-ask spread. These costs add up over time and quietly eat into your returns. The investor who trades once a year will almost always outperform the investor who trades every week, even if they're equally smart. simply because of lower transaction costs. Now I want to share something that Graham writes about that I think is one of the most underrated ideas in the entire book. And that's the relationship between the investor and time. Most people think of the stock market as a short-term game. They watch daily prices. They react to quarterly earnings. They think in terms of months. But Graham thinks in decades. He says that in the short term, the market is a voting machine. It responds to popularity, sentiment, and emotion. But in the long term, the market is a weighing machine. It eventually reflects the true underlying value of businesses. This metaphor is everything. A voting machine gives power to whoever is most popular at the moment. A weighing machine measures actual substance. In the short term, a company can be popular for no fundamental reason, and its stock can soar. In the long term, only the substance matters. This is why Graham insists on long-term thinking. If you're only going to hold a stock for 6 months, then the short-term sentiment matters a lot. But if you're going to hold it for 10 years, the temporary fluctuations are almost irrelevant. What matters is whether the business grows in real value over that decade. This should also fundamentally change how you react to market downturns. If you're a long-term investor, say, someone with a 20 or 30-year horizon, then a market crash today is almost irrelevant to your final outcome. What matters is what the businesses you own are worth in 2045, not what Mr. Market thinks they're worth today. Now let's talk about something that has become even more relevant today than it was when Graham was writing. And that's the question of growth stocks. Growth stocks are companies that are expected to grow faster than average. In Graham's time, the classic growth stocks were companies like IBM or Coca-Cola. Today, people think of tech companies, AI companies, electric vehicle companies. Graham has a nuanced view on growth stocks. He doesn't say they're bad investments. He says they can be wonderful investments at the right price. The problem is that growth stocks are almost always expensive because everyone can see the growth. Everyone expects the growth. And so the price already reflects that expectation. Here's the danger. If you pay a very high price for a growth stock because you expect the company to grow at 30% per year for the next decade, and it only grows at 20% per year, the stock can still fall significantly. Because the price was built on the assumption of 30% growth. When reality delivers 20%, the market reprices the stock downward. This is what Graham means when he says that the intelligent investor is not just looking for good companies. They're looking for good companies at good prices. A spectacular company at an absurd price is not a good investment. A mediocre company at a ridiculously cheap price might be a great investment. This is also why Warren Buffett, who studied under Graham but evolved his approach slightly, eventually started paying more for quality. Buffett was willing to pay a fair price for a truly excellent company, rather than waiting for a deep value stock. But even then, the core Graham principle remains: don't overpay, and always have a reason to believe the price is justified. Now let's bring everything together with a few practical takeaways that you can actually use. First takeaway: know which type of investor you are. Are you truly willing to put in the time and effort to analyze companies deeply? Be honest with yourself. If not, and there's absolutely no shame in this, be a defensive investor. Keep it simple. Buy a diversified portfolio of quality stocks and bonds. Don't try to beat the market. This simple approach will outperform most active investors over time. Second takeaway: always demand a margin of safety. Never buy a stock just because you like the company. Buy it at a price that gives you cushion, where even if you're somewhat wrong, you don't lose much. This one principle, consistently applied, will protect you from the most catastrophic investing mistakes. Third takeaway, separate yourself emotionally from Mr. Market. The market will offer you prices every day. You don't have to react. You don't have to follow the mood. Treat price drops as potentially good news, a chance to buy things you want at lower prices. Treat price increases with caution, not excitement. Fourth takeaway, think long-term. Seriously long-term. If you're investing money you don't need for 20 years, don't check your portfolio every day. Don't react to short-term noise. Focus on the underlying value of what you own. Time is the most powerful force in investing. Compound interest over decades is more powerful than any stock-picking strategy. Fifth takeaway, control your costs. Low-cost index funds beat most expensive actively managed funds over long periods. Keep your transaction costs low. Don't trade too much. Every dollar you save in fees is a dollar that stays invested and compounds for you. And sixth takeaway, perhaps the most important one of all, know yourself. Know your own psychological weaknesses. Know how you feel when markets crash. Know whether you're prone to overconfidence. Know whether fear makes you irrational. Because the biggest threat to your financial future is not the economy, not the stock market, not inflation. It's your own behavior. Graham says this over and over in different ways. The intelligent investor is not necessarily the most intelligent person. The intelligent investor is the most disciplined person, the most self-aware person, the most patient person. Those are the qualities that lead to long-term success. Let me close with something that I think captures the entire spirit of this book. Graham wrote The Intelligent Investor during a time when the world had just survived the Great Depression, World War II, and multiple financial crises. He had seen enormous wealth destroyed by panic and greed. He had seen smart, well-educated people make catastrophically bad decisions because they let emotion override logic. And his response to all of this was not despair. It was a simple, elegant framework. He said, know the difference between price and value. Buy when price is well below value. Be patient. Be disciplined. Protect yourself from your own worst instincts. And over time, not overnight, not in a year, but over the long arc of a financial lifetime, you will build real, lasting wealth. This isn't exciting. It isn't flashy. It won't give you a stock tip that doubles in a week, but it will do something far more valuable. It will give you a philosophy, a way of thinking about money that will serve you for the rest of your life. Warren Buffett read this book as a teenager. He called it the most important book on investing ever written. And everything he has built, everything he has achieved, traces back to the principles in these pages. You don't need to be Warren Buffett. You don't need to be a genius. You just need to be intelligent. And according to Benjamin Graham, being intelligent means this: know what you own, know what you paid, and know why the underlying value justifies the price. Do that consistently, patiently, for a very long time. And Mr. Market will eventually make you very, very wealthy.